o'clock. It's time for us to begin, so I would like to call this meeting of the Public Pension Oversight Board into order. Thank you. Madam Clerk, if you would please call the roll.
Senator Berg. Senator Carroll. Senator McDaniel. Senator Mills. Senator Neal. Senator Nemes.
Present.
Senator Wilson. Representative Bojanowski. Representative Fleming. Representative Graham. Representative Petrie.
Here.
Representative Pratt.
Here.
Representative Tipton.
Here.
Representative Weber.
Here.
Mike Harmon.
Here.
John Hicks. Victor Maddox. Sharon Mattingly. Representative Hale. Senator Higdon. Representative Johnson.
Present. We do have a quorum. We're duly constituted to conduct business. The first order of business today is approval of the previous minutes. You should have those in your packets.
Motion to approve.
We have a motion, second?
Second.
We have a second. All in favor, say aye.
Aye.
All opposed? Minutes are approved. Next item on the agenda is briefings from each of the plans, and we're going to go over cash flows and budget projections for the next few years. We will start off with Bo Craycraft. Coming to the door. All right. You know the drill, sir. Make sure the green light is very bright, and the floor is yours.
All right.
Don't forget to introduce yourself for the record, please.
Guys are using a new PDF reader, so give me just a second. There we go. All right. Thank you again. My name is Bo Craycraft. I'm the Executive Director of Judicial Forum Retirement, and appreciate the time and the opportunity to present this afternoon. As the chair just referenced, I've been asked this afternoon to provide an update on recent investment performance, quick snapshot of asset allocation and cash flow. And then we've also been asked to provide a snapshot of expected budgetary employer contribution request and a little bit of historical data with regards to that. And so with that, I'll get started on slide 2. This is just a quick snapshot of investment performance through the end of the most recently completed fiscal year, which was June 30, 2023. You'll see there that after a pretty difficult 2022 fiscal year where our plans fell across the board about 10%, we saw returns bounce back in 2023. Led by strong domestic equity markets, our portfolios posted a return of just over 15%, depending on the plan, net of fees. And those returns for the 1 year exceeded both our benchmark and the assumed rate of return, which for our plan is 6.5% per year. You know, just as we're going to touch base on the next slide, but we are largely U.S. equity and largely large cap equity, which was one of the strongest performing asset classes over the period. And so, you know, that return has been driven largely by those equity, that equity allocation. S&P was up, 20% for the 12-month period. As you move across from left to right, across the longer time frames, you continue to see the portfolios have provided solid above benchmark returns. I always like to point the 5-year number for a couple of reasons. One, from an actuarial standpoint, returns are smoothed over a 5-year period, but also with the advent of the cash balance plans, that 5-year trailing return is used to tie the upside sharing. So I always like to point that out. Strong returns above the benchmark and the assumed rate of return. And then just a couple of quarters ago, we reached a 30-year track record, and so you can see that over the past 30 years, the return is 8.8%. That is a gross of fee return, but our fees are generally less than 10 basis points. So you're looking at 8.7, 8.8 for a compounding 30-year return. I made reference to it quickly that asset allocation, our policy target is 70-30. 70% in U.S. large cap equity We have a asset allocation that we've testified before is aggressively conservative. It's aggressive in the sense that it's 70% equity, which is a volatile asset class when measured by standard deviation, but it's conservative in the sense that we currently don't do any of what I would call the non-traditional asset classes, private equity, hedge funds, some of the things that maybe are a little bit actually more risk adverse, but can bring on some other risk, not associated with volatility. The other quarter, 30% of the portfolio is targeted to short-term, intermediate, fixed income. Right now, it's largely corporate. Over the last several years, treasuries have not really provided much yield. That is changing. So one of the things you'll notice is, probably if you looked back at these slides a year ago or even 2 years ago, there were times where we were really clipping up, 75, 80% equity. Baird, our sole investment provider, has the authority to go up plus or minus 10%. And, with fixed income yields effectively zero, we have been overweight fixed income. They're consciously pulling that number down. And so you can see now we're at 72%. If we were to look more recently, they've even rebalanced since June 30. They're really trying to shoot for 70-30. For the first time in the better part of my arrival at JFRS, fixed income is actually providing return. So it is now serving as that counterpart to the more volatile equity. This is a quick cash flow for the 12-month period ending June 30. Really not anything specific I wanted to point out here. It's pretty consistent with what you all have seen over the last several quarters and even years. As we've discussed at previous meetings, our plans do have strong funding levels. As we're going to see on the next slide, the employer contributions have gone down, consistently over the last 10 years, or we haven't received any. And so we are in a negative cash flow state, and you can see that in kind of the gray shaded box there. This quarter we also included the net cash flow ratio, which I think was requested by the committee the last time I presented, just to give you a sense of what percent of negative cash flow are we. I think you all have heard testimony prior that anywhere from kind of like a 4 to 6% negative cash flow is manageable. So you can see that the plans are under 2%. But the second thing I'll point out is, when you're in a negative cash flow state, such as the plans are, you're going to be your asset growth or decline is going to be very dependent on investment returns. And you can see that picture pretty clearly when you compare 22 to 23. 22 was a tough investment market, and you saw plan assets decline. 2023, strong investment returns, and you can see large realized and unrealized asset gains. And so the total plan assets have increased. And I just thought it was interesting. You look at the beginning of fiscal year 22 compared to the end of fiscal year 23. The plans are not, far off of where they were, 2 years ago. And we've had quite a volatile 2-year period. The last slide is a quick budget request and just a summary of some recent employer funds that the plans have received. On the top half, you see a chart there that has current and what we are projecting for the upcoming budget biennium. Fiscal year 2024, you can see that we received an employer contribution of just over $5.3 million with regards to the Judicial retirement plan. When we look out to 25 and 26, you can see that I've projected no expected employer funds. I will add a little caveat that this is based off of projections that were produced in 2021. Just to remind the board, we do full funding valuations every other year. We do those in the odd numbered years prior to the budget process. Our actuary is currently, sorting through the data that, to be honest with you, we just provided about 3 weeks ago. And so this data is, projected based on 2021. I'll say that, we just looked at a 5-year investment return. It's still pretty strong above our assumed rate of return. The board has not significantly changed any assumptions. We are seeing quite a bit of increase on the health insurance premium side. So I do expect to maybe see the health insurance funds health deteriorate, but those were already in better shape than the pension side. So I'm cautiously optimistic that these projections will be accurate with regards to JRP. On the LRP side, we have not received funds. We really have not received employer contributions since fiscal year 18. We did receive a couple appropriations in 19 and 20 for administrative expenses. We've since changed our process. That administrative expenses are now incorporated in the valuation and included in that ADEC, or the employer contribution. But I do expect, again, similar story to JRP, that those would be there would be no request for the current biennium. With that, that's really all the prepared comments that I had. I did include a recent market commentary from Baird Investment Trust with regards to a topic that's been kind of hotly discussed recently in artificial intelligence. I found it kind of interesting, so I thought if you're bored and you want to read for a few minutes, it's just a couple of pages, but I always find that commentary to be pretty educational. Happy to answer any questions members may have.
Thank you, sir. I think we have one question from Representative Tipton. The floor is yours, sir.
Thank you, Mr. Chair. Bo, if you'll pull up that cash flow chart again. On the LRP plan, fiscal year 23, is that a misprint there on the total cash inflows?
It's a misprint on investment income.
Okay.
It should be 4.0.
I just know I knew the numbers didn't add up there.
Yeah, that's a good catch. It got copied over from 22,
Okay.
but as you can kind of back into that number.
Sure.
The 4.033 is correct. So,
Okay.
as you can, net investment income did go up in 23
Okay.
for that plan.
Just wanted to double check that. Thank you.
Any other questions from the board? I have just one real quick one, maybe two. So just to reiterate, for the benefit of the chairman of A&R, you did say that you're not looking to make any requests for funding for 24 and 25, correct?
With a
24.
slight caveat, we will have preliminary information before October 1st, which I know is the goal. I've asked the actuaries to try to, provide an update, but I am cautiously optimistic based on investment returns and based on the fact that we did not significantly change assumptions.
Chairman Petrie, do you have a question?
With no caveat, I would just simply say amen.
I will amen the amen. I do have one other question. If we go back to slide 3, if we can get there quickly, it's not critical to have it up there, but you show that your cash on hand, cash assets is 1.1%, which makes total sense to me. But my question is that within the, what is your target for cash on hand? Is that it? Or?
We try to stay fully invested. To be honest with you, most of that cash was due to some maturities that we had right at the end of the quarter. We try to tie our maturities to handle cash flow for benefit purposes. In June, we got we got an appropriation on the judicial side, but we had a couple bonds that just had not been reinvested yet. So most of that is more of a timing issue. I think, if you looked at us currently, I know we have bought several bonds this week and over the course of June as well. So,
Very good. Thank you for that. Any other questions from the board? Seeing none, thank you, Bo, for the briefing. We will see you next time. Up next is Mr. David Eager. Sir, if you'd like to come up. If both of you would like to get that green light on and introduce yourselves for the record.
Sure.
David, the floor is yours.
I'm David Eager. I'm the Executive Director of the Kentucky Public Pensions Authority.
I'm Steve Willer. I am the Chief Investment Officer for KPPA.
I've said before, I always enjoy being here, believe it or not, particularly when we have good news, which we have today. Let me give you just some of the highlights. To begin with, there's extremely wide variance in returns. Large cap growth equities are up 27.7, 10-year Treasury down 6.5. It made a lot of difference where you were, where you invested. We pay a lot of attention to that. Unlike Bo, who's 70+% in equities, our K non-haz is about 35 and C non-haz is 45. And we're really limited by, I used to say liquidity, not so much liquidity now, but just by the ability to take risk in the unfunded positions. Number two, we met or exceeded our benchmarks in all 10 plans, 5 pension and 5 insurance. If you take the composite of the pensions, we were up 954. It ranged from about 7 to 10.3, depending on the plans. But when you aggregate it, 954. And you always have to say, well, what's that compared to something? Well, compared to CalPERS, it was 5.8. Compared to CalSTRS, it was 6.3. Compared to Callan's 25 billion up asset pool, and we're at 24 something. It was 7.0, and finally Wilshire, $1 billion and above, 7.6. So we fared well with our benchmarks. We fared well with the with other funds that we look at. We are still working on asset allocation, and Steve's going to talk about that. We're outside of the bands on a number of asset, and he's got kind of not only the reasons we may be there, but what we're doing about getting back inside the bands. Cash flows, very positive. If you take all the 2Ks and the C plan and you aggregate it, we were $315 million positive cash flow. And the first year I came here in 2016, we were negative $700 million. Quite a swing, and it's all, a lot of it, if not the entire amount, is due to the contribution. Contribution rates go up, helps the cash flow. So we're in good shape there. And finally, you'll see a major decline in the contributions required for 25 and 26. So, Steve, you want to go?
Sure. Good afternoon. So as Bo mentioned, as Dave mentioned as well, 2023, the fiscal year 2023 and fiscal year 2022 were very challenging investment landscapes. I think the most striking observation to make is that the dispersion of asset class returns was one of the widest we've seen in a number of years in fiscal year 2023. As Bo mentioned, large cap growth really dominated the investment landscape. That was the strongest U.S. large cap growth, was the strongest performing asset class for the fiscal year. But it was also very narrow. So the participation, which is typically a sign of health of a market, was really narrow for U.S. equities, dominated by large cap growth. And in fact, the 10 largest U.S. stocks accounted for over 50% of the overall return of the market, which is typically not a very healthy sign for markets. And that's one of the reasons we've been cautiously optimistic in deploying capital over the past 12 months and especially over the past 6 months. You'll notice that there were a number of asset classes traditionally that serve as ballasts that actually produced negative performance for the fiscal year. Those included real estate, all of fixed income, credit and government bonds, private equities, and commodities. Again, those typically tend to be your more stable asset classes, ones where you're going to see less volatility in performance, and they all produce negative performance for the fiscal year. For performance, as Dave mentioned, all of the plans exceeded their assumed rate of returns. We, as of June 30, had 2 different sets of assumed rates of returns depending on the funding status of the plans. All of the plans, all 10, insurance and pension, also exceeded their specific benchmark, their investment policy statement benchmark, which I think staff was encouraged by the durability of the portfolio performance over the year. Not just, we talked about 22 and 2023, but even within 2023, we saw very strong trending markets negative and very strong. The second half was a very strong trending positive market. The bulk of the performance that we saw, the outperformance relative to our benchmark, was produced really in the manager selection, so how our managers performed, which is encouraging that they were able to produce positive outperformance in both negative and positive markets. And it was also the asset allocation within those broader asset classes that KPPA investment staff, how we allocated within those specific asset classes. And really it was in public equities and core fixed income, which combined produced about 75 to 100 basis points of outperformance relative to our benchmark for the fiscal year. So those 2 asset classes really performed well for us. We look at longer term performance. We've held up well. We see, especially on the pension side, a pretty significant dispersion. If we look at the 1-year numbers and even as we extend out, between some of the plans. And that really is, there's some unique asset allocations. So within the pensions and the 5 portfolios that we manage, we have 3 sets of asset allocations from what I would term a much more conservative asset classification. And that's really, that allocation is lower in public equities, higher in fixed income. Whereas we look at the C non-HAS, has a higher allocation to public equities, which performed very well for the fiscal year. And that's really the driver of that difference in performance between those 2 plans. As we look longer, outside of 5 years, they tended to have more similar asset allocations. And the most recent asset allocation changes are where we saw a distinction, and those have a 6.25 versus a 5.25 assumed rate of return, and commensurate levels of risk in their asset allocations.
And that 6.25 applies to this time period.
Yes, those were recently changed, effective July 1st, so we will have updated numbers. If we look at the insurance trust, the insurance trust have much more similar asset allocations across all 5, so across the K non-HAS, K has, state police, C non-HAS, and C hazardous. So you see performance that is more in line, more consistent across those portfolios. The driver of performance, again, was primarily, even in the insurance portfolios, was outperformance in the public equities portfolios and in the core income portfolios. I think we mentioned last year, going into fiscal 2023, as Bo mentioned, it was a ZIRP world, right? So the rates we were getting in fixed income were pretty low. While we didn't alter our overall allocation to fixed income, we did change our duration profile. So our sensitivity to rates in anticipation that we would see rising rates as the Fed got very aggressive to combat inflation. And that really is what produced the majority, the bulk of outperformance in the core fixed income portfolio, was that shorter duration profile than our benchmark. As rates have risen, for an example now, in our liquidity program, we're getting about 5.5% yield on a daily basis. We manage a large liquidity bucket, and we're anywhere from 5.25 to 5.5 on a day-to-day basis is what we're able to yield in that liquidity program. And that really is a testament to how quickly rates have risen. Obviously, that's the negative impact we saw on a couple slides ago on core fixed income and government bonds. The negative performance they had for the fiscal year was in response to that dramatic rise in the speed and the magnitude of the rise in rates. More recently, we've taken the view that rates are probably near tops. I'm not going to call a top. I think that's a bit of a fool's game, kind of reading the tea leaves of what the Fed may or may not do, and they really are data dependent right now. I think they need to see that they've broken the back of inflation. They need to see that the jobs market has softened, and then inflation is come down in a sustainable way. So we may see another rate hike. We may see another 2 rate hikes, but we're probably near peak rates. So we started to unwind that short duration and extend the duration of the core portfolio, which given the level of rates, is pretty attractive right now.
One thing I would say is we need to remind ourselves that there's $6 billion in those insurance trusts. And we're in the minority that most states, the majority of states, do not pre-fund. So we have $6 billion set away. We have 4 of the 5 insurance trusts are overfunded. You'll see the results of that when we get down to the contributions. And the one that's not is 79%. K-9 has is still 79% in the insurance trust.
So all of the plans in the insurance trust are in very healthy positions. Their appetite to deploy capital in probably less liquid markets, as Bill mentioned, not all risk is measured by standard deviation. There's other forms of risk, and their appetite for that risk can be a little bit higher given their funding status. If we look at the asset allocations, as Dave mentioned, we've been making progress, moving towards what were the recently adopted asset allocation targets and ranges by both the K board and the C board. It's been slow progress, but we are making progress. As we see in red, we've highlighted a number that are outside of the range that's prescribed in the IPS. Where the IPS allows for, especially in private assets where it takes longer to fund, to actually get capital called in some of those mandates, They allow for us to invest in what we consider proxy assets, and that's proxy asset would any asset class that a similar asset class that has a risk and a return profile that we view as similar, and those tend to be more liquid. So ultimately, what you'll see is we'll draw from those liquid assets. We'll draw those down as capital gets called. I would highlight, the real return and the real estate are the two asset classes we're most efficient. Those were the ones that had the most significant target changes in the IPS and a change in what their the ranges, allowable ranges were. So we're deficient in those two asset classes, but we have about $400 million in committed capital in real estate, where we've committed the capital to a mandate and we're waiting on the managers to call. Likely to see, I know we have a couple in October where we're expecting some sizable calls in capital in October from our real estate managers. In the real return or real asset class, we have about $750 million of capital that's been committed to new managers or to existing managers. I just got an email earlier today that we're likely to receive a $100 million capital call in October on a deal that's closing from one of our new real asset managers. So over time, those, especially in the private asset classes, onboarding those managers, doing our due diligence, committing capital, and then having the managers go out and source investments and call our capital can take several quarters. I would anticipate by early 2024, if not the end of 2023, if all of that capital we have committed was called tomorrow, we would be very close to at target or in range for all asset classes. That's unlikely to happen, but given kind of where the investment landscape is, what the opportunities those managers are seeing, I anticipate a sizable portion of that committed capital to be called before the end of the calendar year.
Okay. Let's talk cash flows. I mentioned at the beginning that in 2016, when I first came here, we were $700 million a year negative cash flow. So that meant the investment department was selling about $60 million worth of securities every month. Whether the market was high or low, they were forced to sell. It's just not a bad position to be in where you don't have the discretion to decide. And we're now in very, very positive territory, particularly with the K plans and the contribution rates we have. So I was going to walk through the first vertical column K has, just kind of the format, remind you of the format. I don't think, unless you choose, I don't know that we need to go into the details of the hazardous and the state police and perhaps even the CER's plans. But I'm sorry? Yeah, okay. First column, K9 has 23 member contributions, 84 million. Employer contributions, 136. And the allocation, 898, and another 240. Thank you very much. You'll see the impact of that later. General appropriation. We had income, that's dividends and interest, 85 million. So we had 1.445 billion coming in cash. We paid out to benefits and expenses 1.049, and that leaves us in a positive position of 395 million. And if you say, okay, well, that includes some investment income, let's take that off the table. And then if you drop down to the gray line, 310 million. So we were 8.6% positive. We're probably an outlier in the pension world in terms of state pensions. 8.6% positive. We have 85 million in income now. Overall, the yield on the assets is 2.37%. The bottom line is we are in really good shape, and it could change, but it should not change dramatically. I think if you elect, I can go into others, but I think in general, the C doesn't look as strong, but there's not a significant problem at all. In fact, go to C just for a sec. Down at the bottom on the C9 has the red 1.25%, says the cash flow as a percent of assets, negative 1.25. I think Bo Craycraft correctly said that somewhere between -3 and -6 is fairly typical for state retirement plans. So C plans are in good shape, K plans are in good shape. And the projections look good. So you asked to take a look forward.
Yeah, before you go, just to
Yeah.
make sure we don't gloss over the other plans, is there anything significantly out of shape compared to what the non-haz was?
No.
For the other
You
ones?
can go ahead and throw that. You're talking about you're talking about hazardous and
KHAS and
state
the
police? Yeah,
police.
not at all. State police is the only red number up there, and it's 1 million negative cash flow.
Okay.
And now that we're at a 50+% funded ratio, and we're still getting contributions at a pretty high level, in the 80% range, in the 80s now. No alarms.
Okay, thank you.
Yep. Yeah. There's really nothing to comment on insurance unless you choose to, but I'm going to go ahead to the 10-year projections, and let me walk through the K9 has. We're looking at 2017 through 2026. If you went back to 17, 18, 19, 20, and 21, which we would call pre-House Bill 8, you can see the contributions were initially 772 and 777. The board in 2017 decreased the assumption rates significantly, particularly the investment return assumption, but others were changed. Caused the contribution rate to go from 49%, as you can see in that rate column, to 83%. So you look at 2019. A board change in 2017 took effect on January 1 of 2018, which is fiscal 2019. Always confusing, but if you look at the rate column, the rate went from 49.47 to 83.43, except for the quasis, who stayed at 49.47. So we had two different rates. That stayed the same each year for 3 years, and then House Bill 8 was passed, and so the contribution got broken into two pieces. One is the normal cost, and for example, in 2022, 145.7. Normal cost is the cost it takes to pay for the benefit that earned in that year. Somebody once described it as like the maintenance on your house, paying the utility bills. The AALC is paying down the unfunded liability. And we converted that from a percent of pay as a part of the percent of pay formula to saying, all right, we're going to allocate that to each of the employers, and whatever their percent of the total is the total they're going to pay. And so beginning of 2022 was $1,014,000,000. It went to $994 for the next 2 years, and it goes to $819 for 2025 and 26. That's the good news. Down $190 million. And there are three components to that. One is the Medicare premiums went down. As a result, our contract with the provider expired, and we put an RFP out. And fortunately for us, we negotiated hard, and they negotiated hard, and we got some pretty significant savings in the next contract. We changed the assumption for turnover. So the experience for recent turnover is much higher than historically it had been and what we assumed. So if people don't stay as long, it doesn't cost as much to fund a pension. And that was a meaningful contributor. And then finally, the $240 million and the two $240 millions played in. So we got a real nice benefit out of that in terms of the contribution rate. And it's not smoke. I mean, it's legitimate. 819 is legitimate, and I would say it's even conservative because we're still using pretty conservative assumptions. Questions?
Any questions from the board? I have just a couple. Oh, got one. Please, go ahead.
Thank you, sir. I have one question. Did we have to do any asset reallocation as on the basis of SB 250 for any of these? ESG.
Not that I'm aware of.
So it didn't have
No.
any impact whatsoever on what the state had its retirement vested in.
Affirmatively, no.
Thank you. Just
Yeah.
curious.
Yep.
Representative Tipton?
Thank you, Mr. Chair. On the Dave, thank you all. On the CERS non-haz rate for 25-26, I know earlier this year we talked about a change in assumption coming. Is that change in assumption calculated into these contribution rates?
Yeah, yes, they are, and it's gone from 6.25 to 6.5. I should have mentioned that. The other thing that I would mention on the C side, the rates going up from 2017 all the way through essentially 2022. There was a phase-in, as you may recall. We couldn't raise the rate by more than 12%. In other words, if it was 20, it couldn't be more than 22.4, and that has expired. And so now we're getting the benefit, able to see the benefit of experience.
Anyone else? Just got a couple of quick questions while I've got you. I don't want you to feel slighted that I didn't ask any questions. So, if we can go back to the asset allocation slide, shows the KER's pension composite, the composite slide. Is that it? I can't see from here.
Yes.
You
Yeah.
got the right slide up? All right, thank you. If we go down to the fixed income category and we look at asset allocations, it shows cash is 15.5%.
That's correct.
Is that correct? And the target is 4.4. I would presume that we have a target for a reason. Is there any reason that we're not closer to that target?
We're not closer to the target because we've earmarked some of that as a combination proxy asset class for where we're deficient. And that's also going to be used, the single source for funding deployment of capital when it's called. We've committed capital to the inflation protected asset class. So in real return and real estate. So we've committed capital, but that hasn't been called by the manager yet. So when the manager calls, it will come directly out of cash.
Okay, and I know you mentioned there would be some calls coming.
Yeah.
Um,
We've actually had debates internally about whether we should take that out of the cash because it's been committed. But it sticks out like a sore thumb.
Yeah, if
when
you looked
get
at
that
asset
way.
allocation on an actual versus a committed basis, it would obviously look very different, but I think this is the most reasonable and transparent way to represent it. Again, part of our view, when we look at proxy asset classes, especially for those that are private asset classes that are harder to deploy, the risk return, the combination of those assets and the risk return profile that they provide, and again, with a rise in short-term rates, that being able to achieve 5.5% yield in cash, and the opportunity cost minimizes the opportunity cost of sitting in cash until that capital is called. The internal debate is always, do we put it somewhere else where it's potentially has more market volatility risk? If we went into a public equities or something else and exposed it to market risk, is that prudent given that we've already committed it to another asset class and we're just waiting on that capital to be called? So those are debates we have. And so that's how we view it, is there's not a single asset class that serves as a really good proxy for real estate, but a combination of asset classes starts to approximate that risk return profile. It may not do so well over shorter periods, but we feel over a several month period that risk return profile is going to be somewhat more similar to say a real estate mandate.
Do you have a projection on what it's going to look like? If you carved out those calls, would you be at 6% or 8% or what?
So if we carved out all of the calls so for the KRS pension composite level, we're looking at about 8% of potential cash that could be called and put into between real estate and real return, somewhere around 8%, maybe a little bit more, because again, we have some within that composite, some of the underlying portfolios are a little more deficient than others, so they would have a higher allocation to what that capital that's going to be called. But I think we'd bring it down probably 8.5%.
So it'd still be around 7.5.
Still be around 7.
Plus or minus.
Yes.
So when the state police gets $215 million in one lump sum, it takes a while to deploy that. And when we get $240, it takes a while to deploy that. And then we had this is getting to be a little bit of history because it goes back a ways. We had a manager we terminated, had almost $1 billion, and it became cash. And
in the real return asset class, it wasn't really a great fit for that. Probably an extension, I should have mentioned this earlier, I think that an obvious question that comes out of this to me is, what did it cost the systems to not be at allocations for the fiscal year? And if I look at, our performance attribution for the fiscal year, asset allocation is one of the categories. And asset allocation broadly across all 10 plans had a very modest impact on overall performance, really from about plus or minus 20 basis points, so 0.2% over the entire fiscal year. And that's, when we do that, we look at if you were exactly on target, at benchmark target, and getting that benchmark performance on a daily basis and not accounting for any transaction cost. if I step back and look at specifically to the asset classes where we were outside of the specified ranges, the impact was actually positive in 9 out of 10 plans, anywhere from 2 to 45 basis points of positive performance contribution. And one plan had a negative performance impact of 16 basis points. So it was relatively modest. Obviously, the asset classes where we were most significantly underweight were some of the worst performing asset classes for the fiscal year. So not necessarily, sometimes it's better to be lucky than good at times. And in this case, that was the case. We were unable to deploy capital quickly in those asset classes, and they underperformed last year.
So I guess what I'm taking from this, and I can see that you're being conservative, hanging on to that cash. And, you know, I like safety there. But I do have to think about when you bring good news, the returns that you've had, and yet we have cash sitting in there that's not close to the target for what we want to have for cash. I'm thinking how much better the news could be if we'd had more cash in. So I would just throw that comment out to you for consideration.
I think if we were sitting in your seat, we'd ask the same question.
We're good. Are there any other questions? Oh, Senator Mills.
Just a real quick question about real estate. You know, we read about these office buildings being empty and vacant. Are we fairly sheltered from those type of bad investments in that type of real estate, or is our real estate more focused on housing, or are we protected, I guess, against that?
So, you know, commercial real estate and real estate generally is a very broad asset class to your point. I think we were very underweight office space relative to any measure of benchmark, and that's been a decision that we made a while ago. So we do have some exposure to office space, but it's pretty limited across our entire exposure. It's more where we have a lot of core real estate, so there is some residential, not a lot. We have some European exposure, so this is not a lot of value add and not a lot of office space.
Farmland.
I have one final question. We have discussed, you have brought to us a desire to lower the contribution rates, the employer contribution rates, and I guess
that's going to fall out of the valuation process.
Okay. Well, I'm just thinking about as we go into the next budget cycle, I just want to make sure that we're understanding with our funded status. Still a little concerned that we could be continuing to put in the amounts that we've talked about and we've done in the past and improve that funded status. Can you comment on the thinking behind that issue, that concern about where our status is versus a desire to lower the rates at this point?
Yeah. Well, the funded status is going to continue to improve, but anytime we get an additional appropriations, it gives it a bump. So, but initially now we're moving in the area of perhaps 2%, 2 to 3% improvement. 18.5 to maybe 21 or 22. It's going to take a long time. I keep saying it's like paying off a mortgage, but when it's when there's an additional appropriation. But let me step back. I am confident that the assumptions we're using and the advice we're getting from our actuary are very, very sound. They are, if anything, as conservative as we want. I mean, they're strongly and watching out for the funding of these plans, and so we're not on any kind of a bad trajectory, just a long trajectory. But any additional appropriations can either do one of two things: it can shorten the time frame, or it can reduce the rate between now and 2049. Those are the two options every time you get additional money.
I would just mention that we have some sobering numbers coming up for the coming years, 28, 29, that time frame on overall costs. And so anything we can do that is going to help us soften that blow a little bit, I would encourage that we do that.
Yep.
Any other questions from the board? Seeing none, gentlemen, thank you for your time. Thank you for the presentation.
Thank you very much.
Moving on. Last but not least, Bo Barnes, come on up. I feel like the price is right sometimes, you know. Come on down.
They don't come running like
No, they do not. I'm not seeing any screaming and shouting as they come down. So, Bo, if you would, you know the drill, if you'd introduce yourself for the record, and the floor is yours.
Yes. Thank you, Mr. Chair. Bo Barnes. I serve as Deputy Executive Secretary and as General Counsel for the Teachers Retirement System. Bring this up. Okay. For my presentation today, we will start with investment returns, and we have really good news to share too about investment returns, because we had some very strong returns for the fiscal year ending June 30th, 2023. Particularly, we saw strong growth in U.S. large cap equity, international equity, and high yield bonds. These are, as I always caution with these presentations, we're so soon after the June 30th period that these are still preliminary return numbers and they're unaudited, although typically even after they're audited and final, if they do change any at all, they change very, very little. So what you see here today is probably very close to what we're going to be seeing here very shortly. As always with this slide, I focus on the bottom row of the box. And we'll start on the left-hand side, in the bottom corner of that row, and you'll see net. So this is the net returns that I will be going over. So you'll see for the quarter ending June 30th, 2023, for that quarter, for just those 3 months, the returns were 3.61%, which placed TRS in the top 7% in the nation among other large public pension plans, defined as pension plans with $1 billion or more in assets. The one-year return, very strong, 10.26% top net return, top 6% in the nation. 3-year return, 8.39%, top 50% in the nation. 5-year return, 7.24%, top 25% in the nation. 10-year return, 8.22%, top 11% in the nation. 20-year return, 7.32%. We don't have comparable data for other public pension plans for that time period. And in the box at the bottom, you'll see our 30-year compounded gross return was 7.7%. So we are a long-term investor. We know markets go up, markets go down. We have good years like this year. We have years that are not as good like last year. But we know over the long haul, as we are a long-term investor, we're going to have overall good returns, and that's what history has demonstrated. Our current assumed rate of return is 7.1%. As you may recall, that was lowered recently by the actuary as a result of a 5-year experience study for the period ending June 30th, 2020. And you will note that in all of these time frames that have at least a full year included within the time frame, the returns have exceeded 7.1%. And those were the returns, for the Retirement Annuity Trust. These are the returns for the Health Insurance Trust. Has a little different asset allocation than the Retirement Annuity Trust. And again, focusing on the bottom row, the net returns for the quarter, 3.81%, 1 year, 11.56%, 3 year, 9.74%, 5 year, 7.5%, 10 year, 7.39%. We don't go beyond that because, and we'll discuss this later, having a funded health insurance trust is something that's relatively new. It came about as a result of 2010 legislation called share responsibility, which I'll discuss a little later. And again, you'll note in all those time frames that include at least a full year, the returns were above 7.1%. Cash flow. This is the same format that we presented to the board before, so it will be recognizable to, I think, everyone. But just again as a reminder, we can sort of divide this slide into thirds. The top third reflects cash inflows. The middle third reflects cash outflows. And the bottom third is kind of the results of those cash inflows and outflows. And at the far right, you'll see two columns with numbers in them. One on the far right provides numbers for the fiscal year ending June 30th, 2022. And just to the left of that, fiscal year June 30th, 2023. So for comparison, we have the 2022 in there as well. So we'll start with cash outflows. You see on the top line, member contributions. In 2022, they were $357 million, and they increased to $368.5 million in 2023. This next line is always a little bit misleading. The next line is employer contributions, and we're getting all this employer reporting coming in at the end of the fiscal year, June 30th, and we are still having, some timing issues getting all of that accounted for. So you'll see that it looks like it declines from fiscal year 2022 to 2023 from 1.679 billion to 1.146 billion. But when we finally reconcile, get all the other employer contributions coming in, their reports reconciled, that will actually increase, and it should come out greater than 1.69 billion because we saw payroll growth for the year about 2.4%. The next line is investment income. This reflects stock dividends and interest on fixed income bonds. And you'll see that that grew from 2022 to 2023 from 359 million to 383 million. So total cash inflows, and again, this is going to grow when we have all the final employer contributions in. It's reflecting 2.396 billion in 2022, 1.898 billion in 2023. But again, when we get those final employer contributions, the 2023 number should be larger than the 2022 number. Now I'm going to the middle third of this slide. And again, this is for the Retirement Annuity Trust. I have one for the Health Insurance Trust next. But you'll see the benefits paid out, the pensions and other benefits were paid out. We increased slightly from 2022. 2022 was $2,332 billion in benefits, and 2023 is $2.42 billion in benefits paid out. Administrative expenses increased from $12 million to $12,900,000. A lot of that was that the state awarded an 8% across the board salary increase for state employees statewide. A lot of that increase is that. So total outflows increased slightly in 2023 from 2022 from 2.344 billion to 2.432 billion. Cash flow, we had a positive cash flow of 51,600,000 in 2022. The reason for that is that in 2022, that the budget for 2022 provided for payment of certain liabilities the state made in lump sum as a $479 million payment that the Commonwealth made in that budget. So that helped with the cash flow, so we had more money coming in. For 2023, we're seeing a negative $534 million cash flow. Again, that is, as you heard earlier testimony, that's a very sustainable negative cash flow at about 2%. So at one time, it was much larger than that before we were getting the additional funding that we've been getting in recent years. That's really helped. Our actuary was worried at one time, but now we're in a very manageable amount of negative cash flow. Let's go on down to the bottom third now of this slide. And I'm going to start with the line immediately below the cash flow that I just highlighted a second ago. And you'll see that we had below the cash flow. And you'll see that this line is investment gains or losses, realized or unrealized during the year. So realized, selling investment gains, unrealized, we're still holding on to them, but the value of the portfolio has grown. And you see that was a negative $3 billion in 2022. Again, 2022 was a down year, but we're seeing a positive $1.883 billion for 2023. And this really tells the rest of the side of the story, and this is why you can have negative cash flow, and that's not a bad thing as long as it's manageable, because those cash flow does not reflect these investment gains or losses, which is obviously a huge part of the total funding scenario. And lastly, on this slide, I'm going to focus on just the 2023 numbers, the last two numbers in that second column from the right, and that top number. That is net plan assets in the Retirement Annuity Trust as of July 1st, 2022. You'll see they stood at $22.9 billion as of July 1st, 2022. And by fiscal year end, June 30th, 2023, we are at $24.246 billion in assets in the Retirement Annuity Trust. So over $1.3 billion, a little over a $1.3 billion increase in assets in 1 year. Next, this slide reflects the same format, same information for the health insurance trust. Starting at the top third of the page, you'll see that member contributions increased from 2022 to 2023 from $206 million to $213 million. Employer appropriations, $151 million in 2022, $220 million in 2023. Recovery income, this reflects prescription drug rebates and federal subsidies that we collect to help pay for the cost of health insurance. Those decreased slightly from $144.7 million to $135.7 million. Investment income rose from $12.6 million to $28.9 million in the health insurance trust. So all in, total cash flows increased from $515.5 million in 2022 to $598.4 million in 2023. Moving to the middle third of this slide, with the cash outflows, the benefits paid out. We saw in 2022, we paid out $312.6 million, and in 2023, that increased slightly to $326.3 million. Administrative expense stayed the same at $2.1 million. Total cash outflows increased slightly from $314.7 million to $328.4 million. So we were positive cash flows for both those years, a little more cash flow positive in 2023 than in 2022. As you see, it arose from $200.8 million in 2022 to $270 million in 2023. And again, going to that line just below it, investment gains or losses, we see that was a negative $232.1 million in 2022, but with a good year we just had, we saw that turn around to be a positive $211.3 million for 2023. And again, focusing on the second column, last two numbers, that top number is the plan assets in the health insurance trust as of July 1st, 2022, stood at $2.269 billion. And as of June 30th, this fiscal year end, June 30th, 2023, stood at $2.752 billion. So a growth of almost $500 million in the health insurance trust over the year. Asset allocation. You'll see in the box below this heading, you're going to see on the left-hand side, you're going to see the asset classes in which TRS is invested. Immediately to the right of that, you're going to see three columns with percentages. The first column with percentages reflects the percentage of total assets invested in these different asset classes as of June 30th, 2023. The next column, the column next to that, shows what our target is, what we're shooting for 2024. We want to try to get as close to that percentage as we can. It's always going to fluctuate because the value of bonds, for example, go up. Stocks go up, bonds go down. Then suddenly the bonds are worth a lot more in your portfolio. They're a lot more valued, so your percentage is going to go up naturally. And the last column there reflects the range. We want to stay in this range with our the investment of our assets. So let's look at the top row. U.S. equity, of course, that's stocks. And you can see at June 30th, 2023, we are at 39% U.S. equity of the total, was the value of the total portfolio. The target was 40%, so we're almost right on target. The range is 32 to 48%. Below that, non-U.S. equity, we were 21.4% June 30th, 2023. Target is 22%, so right on top of that. Range is 16 to 27%. Below that is fixed income, bonds. June 30th, 2023, we're at 13%. Target's 15%. Range is 8 to 22%. Real estate, June 30th at 7.4%. Target 7%. Range 4 to 10%. Alternative investments, we're at 8% on June 30th. Target 7%, 4 to 10% range. Additional categories, we are at 10.3% on June 30th. The target is 7, and the range is 4 to 15. And finally, cash equivalents, we are at 0.9% as of June 30th. 2% is the target, so we're low on that one. And the range is 1 to 5%. But overall, all of our holdings are right on target, right on line with where our target numbers are. And that was for the Retirement Annuity Trust. Moving on, I've got a couple of slides here. We've been asked about funding sources and how these benefits get funded. So I've got a couple of slides here that have a little more detail, and then a few slides later, I'm going to get into some very employer-specific slides, funding slides. So this first one in the box below, this is for the health insurance trust, and this is an important thing because health insurance, that retired teachers' health insurance, was on a pay-as-you-go basis before 2010. And I've talked about this before this board, maybe not everyone sitting here today, but it was a pay-as-you-go basis, dollars in, dollars out. And the Commonwealth was voluntarily paying almost the entire cost of retired teachers' health insurance. And I say voluntarily because under that statutory and viable contract we all know about, all that is guaranteed for retired teachers is access to group coverage. But the levels of coverage and how much they have to pay for that coverage depend on the funding available to provide that coverage. So the Commonwealth was voluntarily paying it. We all knew that was not working anymore. We knew this pay-go benefit was not working anymore. So our board directed staff to get together with stakeholder groups for about a year and a half before the 2010 session. We met with them. We met with some legislators, but the stakeholder groups all agreed to this shared responsibility solution. And that shared responsibility solution was for active teachers to phase in over a 6-year period to paying more into the health insurance trust. And that phase-in began July 1st, 2010, and ran for 6 years. School districts agreed to match that phase-in. Retirees under the age of 65 agreed to phase in over 3 years into paying an amount equal to the Medicare Part B premium equivalent towards the cost of their health insurance. And the state, which had been voluntarily paying for almost all of it, took on the responsibility for paying the cost of health insurance for new under 65 retirees, less what those under 65 retirees paid. So just real quickly here, this starts at 2009. Health insurance trust was 3.5% funded. At June 30th, 2022, it had grown to 63.7% funded. And it is on track to be fully funded, 100% funded, sooner rather than later. That is, if medical inflation holds and the federal subsidies that we are still getting continue. But you can just see that first row of numbers, and these are in millions. The state paying $153 million in 2009 is paying, we're asking for $85 million in 2023. Other employers, $11 million in 2009. They'll be paying $123 million in 2023. And retirees were paying $25 million in 2009. They'll be paying $150 million in 2023. So really, really good news there. That was a great legislative solution. Some detail on the Retirement Annuity Trust. I won't spend a lot of time on this, but we have this broken down into 4 different sources of funding. I'm going to start with the third column from the right, state employer fixed. That's that fixed employer statutory contribution. This is for the Retirement Annuity Trust that is paid. And to the left of that is, because that's not enough to pay for the normal cost. That's not enough what we need to put aside for each year of a teacher's career, that with very important investment income, we can pay for the retirement benefits when they retire. We were asked for additional funding to sort of meet what we sometimes call the ADEC, okay? And you can see that, that's in that first column. I will point out 2022 looks strange because it's a large number. Again, that includes the $479 million lump sum payment to pay off some old unfunded liabilities. And then going to the second column from the right, other employers, local school districts pay on federally funded positions. About 10% of the funding comes from them, and universities and some other employers. And then finally, members is on the right-hand side. I've shown these are the 2 charts to this board before, but just again, this real quickly, I won't spend a lot of time on it, but a snapshot of what's happening with this funding, this additional funding we're getting in, that I showed in that first column on the previous slide, is helping us to implement the funding plan to get us to 100% funded in the pension fund, retirement annuity fund. And again, that top column, that's the funded ratio is reflected by that dark blue line. The unfunded liability is reflected by the gold line. And you can see, again, kind of flat still for a few years, but here at the end of this decade, that funded ratio starts to pick up more quickly, and the unfunded liabilities start to decrease a little more quickly. Again, I've used the comparison. It's like a home mortgage. Early years, you're paying a lot of interest, less principal. More principal you pay, it starts to flip eventually. You start paying more and more principal and less interest. And then very importantly, the bottom graph, the required contributions from the Commonwealth of Kentucky, you see when we do get to 100% funded, they drop dramatically from one year to the next. So really good news there with the funding plan being implemented with additional funding that we're getting in the budgets. Here's some other trends. This is focused just on employer contributions. That's the state and our other employers. On the left-hand side of this box, and it starts at 2017, ends 2026. The left-hand side, you're going to see the contributions by the state to the Retirement Annuity Trust on the left-hand side, and by other employers to the Retirement Annuity Trust on the right-hand side. Before going to the remaining portion of this box, let me focus on here. You'll see fairly steady numbers up through 2024, and then you see a sharper increase for 2025 and 2026 of over $100 million a year increase for each of those 2 years. Something specific is driving that, of course, and that is the result of that 5-year experience study I talked about earlier for the period ending June 30th, 2020. As a result of that experience study, the actuary lowered our assumed rate of return for the Retirement Annuity Trust from 7.5% to 7.1%. Very conservative number. But because of that, we recognized that as valuing our liabilities immediately. You know, we increased our liabilities in our annual financial report immediately to reflect the 7.1%. But we are phasing in, as recommended by the actuary, the budget impact over a 5-year period. So instead of doing it all at once, every year for 5 years, we're increasing the budget request to reflect that we've gone from 7.5 to 7.1. At the end of that 5-year period, it looks more like it did before 2025. It's a little more level than what you're seeing here, because you are going to see some steeper increases for 5 years.
Hey, Bo, before you leave this slide, I just, so we don't want to have to come back to it. If you don't mind, I'm going to interrupt for just a second. No. So, and I think you just said this, so we're seeing increases for this 5-year period. I think I just heard you say that once we get past this 5-year period, the increases aren't as steep. Is that what I heard you say?
Yes. If you go on out, they tend to, they're under 100 million. Here they're a little over 100 million. After this, we get closer to a $50 million a year increase. So, and it's going to vary every year, but it does decline. We're seeing the steep increase, and once we get there, then it's blessed. And we have some numbers on that. Certainly, we can share some projections we can share.
David, if you could take it out for maybe 10 years. Even though we've got a 5-year window here, but I think we need to start looking long term as much as possible.
Yes, sir. Yes, we have projections. We're glad to share. Let me know. I know the Commonwealth is paying more in the budget now for over the 5 years. It gets kind of steeper, but I will note that 7.1% it's a conservative projection. As you saw in that previous slide, for every time frame that had at least a full year in it, we beat 7.1%. So if we continue to beat 7.1% in the future, on average, not every year, not going to do it every year, but on average, do better than 7.1%, that means we're getting a lot more funding in here and getting this in better shape, even more. And so we'll eventually, we'll have cost savings for the Commonwealth. The middle,
and I think again, I'm sorry.
Yes, sir.
I think I'm going to let a couple of the questions that we've got go ahead and be asked
yes,
before
sir.
we move forward. Senator Byrd, did you have a question?
I did, sir. Thank you. It goes back a couple of slides. Can we go back to that asset allocation slide? So I had 2 questions on this slide. So I see the U.S. equities, the non-U.S. equities, the fixed income, real estate, alternative, everything below non-U.S. equities, all invested in the United States, right? Only 16 to 27% of all of this money are we allowing to be invested outside of the state, or outside of the country?
Well-
or are we actually, is it higher than that if you include everything else?
Yeah, it's going to be a little higher than that, certainly. And I'll give you an example. Let's look at alternative investments. And alternative investments has in it private equity, which means basically the way that's structured, there's a general partner and there's a bunch of large institutional investors like TRS who are limited partners. And the general partner is engaged in the business of business. And it can be a lot of different things. Anything, any business imaginable, anywhere in the world. So private equity is not restricted to U.S. investments. They're looking for the best values, and those can be overseas. Now, most of our investments, and sometimes you hear the debate, what's domestic versus international, because so many companies now have overseas footprints, huge overseas footprints, and exposure.
It's a small world.
So, but you characterize our portfolio as being, largely U.S. and mostly publicly traded. About 80% of our portfolio is publicly traded.
So clarification, when we say largely U.S., we're not looking at that 16 to 27 in our range. We're looking more, 30, 33, 35, all told. What do you think? What percentage of this money is not being invested in the United States? That's my question.
I will probably like to come back with you on that one. And again, we can break this down. U.S. based companies. Even though they have significant, obviously overseas operations, we're going to call that domestic. But let me try to come up with some way to quantify that for you, and be glad to do that.
I would appreciate it. It's something that I have constituents who don't feel that we should have money invested outside of the United States. So it'd be just nice for me to know what percentage of the money that we're dealing with is not actually being invested in this country.
Okay.
Thank you.
I will say, you have constituents that are concerned. Our managers and our internal, we do a lot of due diligence. I mean, they're being careful about where they are investing overseas, and they take risk into consideration when they are investing. So anyway, I'll get that. I'll get something for you. Thank you.
While we're back on that slide, thank you. While we're back on that slide, it just occurred to me, I'm curious about what's in alternative investments and additional categories. Not looking for an answer now, but if you could just shoot out an email and kind of
It's
explain
quick. It's a
those.
quick answer. If you
Okay, sure. Go ahead.
The alternative investments is the private equity I was just talking about, and the additional categories are private credit, like private bank loans, and also timberland. We have timberland in the Upper Peninsula of Michigan, southeastern United States, and northwestern United States.
They haven't burned down yet?
No.
Okay. Representative Petrie. Chairman Petrie, did you have a question?
Only thing I was saying earlier was when you asked for 10 years of projections, if we could get that out to at least 15, that's all.
They're required to do 30-year projections and evaluation.
Okay, so no problem with 15?
Oh, no. We have provided and request legislation of 30-year projections.
Perfect. 30 would be great. So if you want to continue, sorry to interrupt like that. Thank you.
Let's see. This slide, okay. We just finished the left-hand side of this chart here, and that was for the retirement annuity trust numbers, employer contributions to the retirement annuity trust divided by the state and also our other employers. Now moving to the middle section of this box, same kind of numbers for the health insurance trust. And you can see that the states on the left-hand side and what the other employers are contributing on the right-hand side since 2017. And on the far right, we're just combining all those numbers, all those contributions to the retirement annuity trust and the health insurance trust, and projecting those out to 2026. And of course, those are projections. Those can change. Okay, this is my last slide, and we were asked to provide our budget request for 24-26, and 24, of course, is actual. That's what we got in the budget. You'll see there on the left, actual FY 2024. We received in the budget $650,706,000 for the pension. The Commonwealth paid towards the shared responsibility towards health insurance, $77,700,000. These numbers do not include SEEK formula numbers. These are the numbers that are in our budget request. TRS makes these budget requests. The SEEK formula, of course, is a budget request from the Department of Education. They ask us for numbers, but they make the budget request. If you were to add SEEK dollars to 2024, that'd be about another $448 million that comes through SEEK. Now, preliminary FY 2025, you can see because we're phasing in, lowering the assumed rate of return from 7.5% to 7.1%, an increase from $650 million to $809,940,000 preliminary. That can change, but that's where we are right now. For the pension, $76.9 million for health. And SEEK, again, this is just an estimate, about $460 million in SEEK dollars. And then moving over to the far right, the preliminary numbers for FY 2026 pension, again, phasing in that 7.1%. We're seeing it go to $907.250 million. And for health insurance, the shared responsibility portion of the state's portion, $84.2 million. SEEK, about $470 million projected. And I'll add something here. The SEEK formula, it's always a projection because that's a percentage of payroll that's requested. And so we're projecting what payroll is going to be for the next 2 years. And nobody knows with certainty what that's going to be. So after every 2-year budget, there's always a look back and were we over or were we under? If we got more than we needed, then we give the Commonwealth credit in our budget request. If it was less than what we needed, then we ask for the additional as part of the over-under reconciliation. That concludes my presentation. If there are any questions about these slides or anything else, I'd be more than happy to take those now.
So we have one question in the queue. That's Mr. Hicks. John, do you have a question?
Yeah, thank you, Mr. Chairman. Actually, one quickie and maybe one other one. What is fiscal 27 year 5 of the phase-in?
I'm sorry?
Is fiscal 27 year 5 of the phase-in?
Let's see. Yes. Wait a minute. Let me go back. I apologize. That's something. So it started started 25. So it should go through 29. I mean, the first year will be 25, fiscal year 25. It should go through 29. It's a 5-year phase-in.
Okay, because I remember in the last budget we had a phase-in element in the budget we're in.
Yes.
From the experience study. So
yes.
That would have been 7 years.
Well, the experience study was concluded for fiscal year 23. Yeah, I think that's correct. I'll confirm that. But yes.
And then lastly, is the rate of return the only element remaining to be continuously phased in?
Yes. All other, like the demographic change, which changed significantly, raising the ages of our members, the assumed ages of our members' mortality. The budget effect of that was made immediately.
Are there any other questions from the board? Seeing none, Bo, thank you for the presentation. We look forward to the numbers that we discussed. If you can send those out to us.
Thank you, Mr. Chair.
Is there any other business to be brought before the board today?